All right, let's talk about one of the most powerful but often overlooked tools for navigating the precious metals market. I'm talking about the gold to silver ratio. We're going to dive into exactly how this simple number can signal some absolutely massive opportunities for timing your moves.
So here's how we're going to break it all down. First, we'll look at a shocking event that literally split the market in two. Then we'll get into what the ratio actually is. From there, we'll see why silver is such a wild card, lay out a classic trading strategy, and wrap up with a huge development that could be changing the rules of the game as we speak.
To really get a feel for the power of this ratio, you have to see what happens when a market snaps. And in late 2025, the silver market did more than just snap, it completely shattered. What happened revealed this huge crack between the Eastern and Western markets and proved without a doubt that the price for physical metal can completely detach from the paper contracts.
So get this, it's Christmas Eve, 2025. The markets in New York and London are pretty much asleep. But over in Shanghai, something absolutely wild is happening. The price for physical silver, we're talking actual metal you can hold, shot up to an incredible $85 an ounce.
And this is where you can see just how big that break was. While traders in Shanghai were scrambling for physical silver at $85, the paper price back on the COMEX in New York was hovering around 72. That's a massive gap, a premium of over 17%. So you have to ask yourself, what on earth was going on to cause a disconnect that huge?
Well, the answer to that question, and really the key to spotting these kinds of opportunities before they happen, lies in a beautifully simple tool that we're going to decode right now.
It all comes down to the gold to silver ratio, or the GSR. For a minute, just forget about the dollar price of gold and silver. This ratio is the ultimate cheat sheet for relative value. It just asks a simple question. How many ounces of silver does it take to buy 1 single ounce of gold? Is silver a bargain compared to gold, or is it getting pricey? The ratio tells you everything.
And this right here, this is the historical playbook. For decades, whenever that ratio has climbed above 80 to 1, it's been a screaming buy signal for silver. It's telling you silver is dirt cheap compared to gold. On the flip side, when it drops below 50, that's a sign that gold is the better value. The market always, and I mean always, seems to want to pull this ratio back to its average, a powerful force called mean reversion. So, if the ratio is the signal, the next piece of the puzzle is understanding why. Why is silver the one that always makes these huge, dramatic moves that cause the ratio to swing around so much? The answer is high beta. Just think of silver as gold's younger, more volatile, more dramatic partner. In a bull market, this gives you insane leverage. It's not at all unusual to see silver jump 3% for every 1% move in gold. This is the rocket fuel that can slam that ratio down and create those massive opportunities for gains. So why is it so volatile? Well, unlike gold, which is mostly seen as money, silver has this dual personality. A whopping 60% of its demand comes from industry. We're talking solar panels, electric vehicles, all our electronics. It's absolutely essential. And this dual demand profile makes its price react to both investor fear and the health of the global economy. Okay, so let's put this all together. How do you turn this knowledge into a real, actionable strategy? Well, you can use these extreme swings in the ratio to help you time your entry and exit points. This is the classic mean reversion playbook, and it is beautifully simple. When the ratio gets stretched way out, let's say it's over 80, you swap your gold for the cheaper metal, silver. Then you wait. As the bull market really gets going, silver's high beta kicks in, it starts to outperform gold, and that crushes the ratio back down. Once it gets back towards its historical average, somewhere between 55 and 40, you swap your now much more valuable silver back into gold. The end result, you own more ounces of precious metal than you started with. Simple as that. But here's the twist. Just as this classic playbook was proven right in that incredible 2025 squeeze, a huge new player entered the field. China made a move that could fundamentally change the entire game for 2026 and beyond. In late 2025, Beijing basically said, our silver is for us. They got rid of their old quota system for exports. As of January 1st, 2026, if you want to export silver out of China, you need a strict state-controlled license. The message is crystal clear. They're building a wall around their silver supply to make sure their own high-tech industries, like solar and electronics, get fed first. So this leaves us with a massive, and I mean massive, question. The historical playbook, this whole mean reversion strategy, was built for a world where silver could flow relatively freely. But now, with the world's biggest producer and consumer basically taking its supply off the global market, can we still rely on those old ratios to guide us? Or has the game fundamentally and forever changed?